In this example problem, we're going to go over how to account for investments in common stock. So as the problem says here, both Geco and Hinbro have 100,000 shares of no par common stock outstanding. Globe acquired 10,000 shares of Geco stock for $6 per share and 30,000 shares of Hinbro stock for $12 per share in 2010. Both securities are being held as long-term investments. Changes in retained earnings for Geco and Hinbro for 2010 and 2011 are as follows. Now before we even start this problem, one thing that you'll want to notice is that 10,000 shares of 100,000 is 10%. So that would, and since it's being held for as a long-term investment, that would qualify this as an available for sale security. But Hinbro, Globe bought 30,000 shares of Hinbro, and 30,000 of 100,000 is 30%. So this is gonna be held as an equity security for Globe. So these two things are accounted for differently, and that's obviously what this problem is about. And so here's the financial information for these two companies for the 2 years, 2010, 2011. And what the problem wants us to do is give the entries required on the books of Globe for 2010 and 2011 to account for its investments in Geco and Hinbro. So the first entry of 2010 is this right here. We have a debit to cash for $37.50 and a credit to dividend revenue for $37.50. Now Globe owns 10% of Geco stock, so therefore the cost method is used, and the dividend is computed just by taking the $37,500 dividends paid by Geco and taking 10% of that. That's $37.50. The next one is the investment in Hinbro stock for $21,000 and the income from investment in Hinbro stock. Globe owns 30% of Hinbro stock, therefore they claim 30% of the income, which is $21,000. So you can see that the income for Hinbro for 2010 is $70,000. 30% of that is the $21,000. Now, at the end of 2010, you've got to make a market adjustment to available for sale securities. Geco stock is being held as a long-term investment. It's properly recorded as an available for sale security. At the end of 2010, Geco stock was worth $7.50 per share, which is an increase in overall value of $15,000 from what Globe paid for it whenever they bought it in 2010. So you have a debit to market adjustment and a credit to unrealized decrease in the value of an AFS security. Now in 2011, we're going to have the dividend revenue again from Geco. Geco is being held as an available for sale security, so its dividend revenue is reported as the same, as for what it is, dividend revenue. 10% of the $45,000 paid in dividends equals $4,500. So that's pretty straightforward. This one is a little bit different. Because Hinbro is classified as an equity security, Hinbro's dividends are recorded under the investment in Hinbro stock account. And 30% of the $20,000 dividends is $6,000. So what this is doing is it is actually lowering the investment in Hinbro stock, because Globe is accounting for this as an owner of the company. So as dividends are paid out, that's part of its investment going away, actually, instead of gaining it like it is for the available for sale security. So let's see, for the cash dividends of $20,000, they take their 30% of that, and yeah, they're crediting it to their investment in Hinbro stock. Now at this next transaction, this is to record the share of Hinbro's income from 2011. So of the $40,000, Hinbro net income 2011, $40,000 right here. They take their 30% of that, and as you can see, 40,000 times 30% is 12,000. So they're going to debit their investment in Hinbro stock. It's going up $12,000, and their income from the investment in the Hinbro stock is the 12,000. Now at the end of 2012 again, you have an unrealized decrease debit to the value of the AFS securities. This is because the market value of Geco stock went down $1 per share, and Globe owns 10,000 shares, so that's $10,000. And to finish that entry, you credit market adjustment to AFS securities for $10,000.